let's start then with real estate syndication. So today we're going to do a walkthrough of a particular property and just double checking again. Everybody can hear me, right? Yeah? Okay.
Yes.
Okay. All right, and can you see my screen now?
Not yet.
Oh, here, let me go. All right. I did have to step in last minute last week and give a really quick overview of some of the high-level perspective of real estate syndication. So if you haven't seen that, the video is available up on the Inside Blue group. Today, what we're going to do is take a more targeted look at a particular property and just walk through what the process is like to do a real estate syndication deal. I'm hoping that most of you have heard of real estate syndication. It might be a new term to many of you, but real estate syndication is simply the process of pooling funds together from numerous investors and channeling those funds into a real estate project. These funds can be used to acquire property in its entirety, and these funds can be used as an equity contribution to a larger project. So it's basically the idea of getting together however many investors, maybe 30, 40, or 50 investors, and purchasing an apartment complex. And then those investors are owners of the LLC, which owns the apartment complex, and they share in not only the cash flow and not only the equity upsides, and but also the tax advantages. So they're in every ways owners of a section of that building. So a little bit about me. I did show this slide before, and I think many of you know me before. I work in the Internet of Things group. I've got a wonderful family. I've been on a mission over the last 2 years, 2.5 years actually, to convert my portfolio over to real estate. And I've done a lot of education over the last 2 years in order to make that happen, and joined quite a few networking groups across the United States in order to build up the network to make that happen. But in particular, I wanted to get into investments where I have cash flow projections over a 3 to 5 year time period, and I guess it's a timely thing. So that was my goal, is to have some visibility into the future outlook of my investments and to have direct ownership within physical assets that are cash flowing. So the quick disclaimer: we are a strictly SEC compliant company. We do not advertise any current properties that we are working on. The SEC, most of these syndications fall under the SEC regulations for in the 2012 Jobs and Tax, the Jobs Act, in Regulation 506B. And Regulation 506B says that we cannot generally advertise any properties that we are currently working on. So all the information that is in here is on past properties that are no longer opportunities for people to be involved in. We do not make any projections to anyone who does not have a pre-existing business relationship with us. So if you do want to talk about the current projects that we have available, come talk to us and we'll have a conversation about your goals and see if it's a good fit. The second part of this is that the views represented here do not reflect the views of Intel. This is an independent presentation, and Intel is in no way responsible for the content. All right. So over the past 2 years, my company, which is named Elan Capital, has partnered with other companies that are in this business in order to acquire a couple of different properties that are starting mainly in the Houston area. And we're going to focus in on this property right here, Camino Del Sol, which is 122 units. It's an interesting case study because it's got it's a good case study. They're all good case studies, but this is I'll go into the details of it. The value add, feel free to stop me at any time and ask questions at any time. I know I'm going to be covering a lot of information. I've also taken a lot of pains here to actually pull up our actual investor presentation which apparently is sitting at the end right now. Okay, our actual investor presentation that we sent out to investors who were investing in this particular property, including, our executive summary and investment highlights. I'll show those to you in just a moment. So the value add business model, this is a business model where you first of all do market intelligence and evaluation in order to determine which markets in the United States you want to be involved in. So for instance, it's well known that on the East Coast, the West Coast, there are a lot of appreciation-based markets where the value of the asset is not necessarily tied up in the month-to-month cash flow that you can generate, but it's tied up in the value of the asset. And you realize those gains on a refinance or on a disposition or sale. So we are looking specifically for cash flowing properties, which tend to be in central markets. So in markets where populations are moving to, and I'll actually get to that on slide 10. So the first step is market intelligence and evaluation. Second step is building a team that's on the ground as well as has the right components in place in order to do the acquisition. The third step is doing a remote analysis, gathering all the facts and information that you can about the area, about the property, about the trailing 12, which is the previous 12 months of profit loss statements, as well as the rent roll and doing a lease audit and market survey. So things that you can do remotely, and I'll actually go through and show you documents that go through in detail what those look like exactly. And then the second part of this is making a offer on the property, getting that offer accepted, and once you get that offer accepted, going into a due diligence phase where your entire team will fly out to the property and perform physical inspections. And next you have creating the partner package or the limited partner investment package. So once you've created your investment thesis, you have your budget together, you have all of the information that you need in order to present to investors, you'll create videos and presentations that contain all the information that an investor would need in order to evaluate the deal. Next step is acquisition, which usually happens 30 to 60 days after the purchase and sales agreement and after the due diligence is performed and the loan is acquired. So this acquisition is usually fairly straightforward. It involves, kind of like acquiring a house. You go into a closing and you have a lot of documents to sign. Money is wired to certain bank accounts and the property is closed on and, of course, registered at the county. Then there's the value add enhancement state. So this is the point at which you are actually executing on your business model. Every apartment that you buy is an independent business, and it has a cash flow that's generated, an expense statement that's generated, and a net operating income. The goal of a value add business model is to increase the net operating income, decrease the expenses, to make a better environment there by improving the property or improving the management operations of the property, and using that in order to generate a return for the investors who have invested. So that is the entire value add business model. And then finally, of course, after the renovations have been completed and there have been a couple of months of stabilized income profit loss statements that can be evaluated, usually you have to have a few months so that the bank can see that you've built up a new level of value and that you're operating at a higher level of net operating income. And if you can show that you have a better net operating income for a certain number of months, it's usually 6 months or more, the bank will go through the refinancing process with you, and you can usually refinance and return cash to the investors or consider selling it. So that's a high-level overview of each of the steps. Are there any questions here before I dive into each one and show documents? Okay. Okay, so first of all, market intelligence. Oh, actually, let me show you a picture of the property. So this is the property. This is Camino Del Sol Apartments. It's in Houston, Texas. It's actually in the southeast corner of Houston, Texas, down here in the Pasadena area of Houston. This area is very well known for a lot of the oil industry which exists in this area. It is a more blue-collar center of town. However, there is quite a bit of population growth, as well as the median household income has been growing in this area. People have been moving to here for jobs. In addition to the oil industry, it's got quite a bit of aerospace and quite a bit of medical industry, as well as a variety of other diversified economic jobs. And so it is it's got a good job diversity and a growing population, which are two of the things that we want to see when we're looking at an area to consider for investment. So 4 things to look at really quickly are the population growth. One of the rules of thumbs that we use in order to qualify an area is that if a area has more than 250 people, in between 250,000 people and 1 million people, it should have at least 20% population growth between 2000 and 2019. And the reason for that is that it's easier to fill your vacancies when there's a lot of population growth. So the more population growth there is, the easier it's going to be for you to hit your business objectives in rent growth. Median household income. So we look for areas that are 31.5% growth between 2000 and 2019. Medium home values, we look for a 40% growth in medium home values. And these are rules of thumb. Generally, you want to see upward trends that are moving at certain rates. And a lot of the cities in the middle of the country and in the Sun Belt are hitting these. We're seeing a lot of population growth along the Sun Belt, particularly in Florida, which we're actively looking at right now, as well as Texas. In fact, I think I have my Florida marketing memorandum up here. And then crime. Crime should be falling in these cities. We do not want to invest in areas where crime is high. People like to feel safe in their apartments, and being able to provide a safe place for people is a high priority. In addition to being able to feel safe, just knowing that you have a stable situation there. Now, you can invest in areas that are on the trend towards lower crime. There is, particularly, for instance, we've looked at Memphis quite a bit. And Memphis, it has a higher crime rate in the majority of it. However, the north and eastern sections of the city are gentrifying, and their crime rates are dropping, while other statistics such as median home value and median household income are increasing. So there are areas that are going through transitions, and if you're looking for workforce housing that is on the rise, areas like that can be promising, but you do have to be very careful about knowing the area in particular. The partner that we partnered with on the acquisition of this particular property, Memphis Millington Oaks Apartments in Memphis, actually owns over 1,200 properties, 1,200 units in this particular area. And so we had a high level of confidence that the numbers that we were given were correct and they could be verified through auditing of financial statements of their other properties. All right. I'll go over a little bit of this fairly quickly. So just knowing the number of units that are coming into the market, how quickly those units are being rented out. This is current information for Southeast Houston, pulled from CoStar, which is a very large data service that is usually only available to brokers and to people who pay for it. I emailed my broker yesterday and received this morning, so this is up-to-date information about the Houston Southeast area. Vacancy rates tend to be at about 10.4%. That's actually a little higher than a lot of areas. Some of the areas in Florida that we're looking at right now have vacancy rates or occupancy rates rather of 94%. So just under 90 is it is fairly high. When we look at the underwriting, this is our underwriting spreadsheet. I'll get to it in a moment. We actually underwrote our financial projections assuming an 87% occupancy rate. And so doing conservative underwriting and knowing exactly what your rates are very key in order to make your projections. We, of course, also want to know the absorption and the vacancy rates over time, as well as market rates broken down by how many bedrooms are in the property. So this, again, is Southeast Houston. And the other thing that we want to keep an eye on is the number of construction projects that are going on currently. I was recently in Denver, and Denver right now is in a situation where they have quite a bit of over-construction that's going on. Everywhere you look, there are new buildings going up. And so it's going to be hard as a value-add business to come in and improve an existing property when people that are renting have the option of going to a brand new property. And so being able to keep an eye on the rates of new construction is key for knowing whether you want to go into an area or not. The other thing that new construction can tell you is that when you're looking at it in terms of a price per square foot, there is a certain point at which the price per square foot gets high enough that value-add business models don't make sense anymore. For instance, in Portland, I have some friends, the Dennis brothers, who are construction workers. And in Portland, prices are high enough that value-add business models don't tend to work and return a good investor return. So what they actually do is they find areas that are zoned for multifamily, but only have a single-family home on them. And they purchase it, they tear down the home, and they put up 12 plexes on the same areas. And it takes about 1.5 to 2 years in order to go through all the city planning and zoning and getting the proper permits and then doing the construction and finally leasing it up. So it's an involved process, but once the price per square foot gets to a certain range, it's worth doing. So we knew that Houston was a great area, and to be honest, our story really started with the people that we met. So we met a team that was down in Houston. The team was Three Pillars Capital, and Three Pillars Capital had been operating exclusively in Houston. They currently have about $100 million in assets. At the time, I think they only had around 50. This was 3 years ago. But we could see that they had a good track record. This was the 7th building they had purchased in the Houston area, Camino Del Sol. And so we entered into a partnership with them. Lucas Farida here is one of the key people on our team. He is involved in broker relations. So every day he's out there talking to brokers, taking them to coffee, attending their kids' sporting events, getting to know them really well, so that when they have a building to sell, they think of him. And so he brings us the building, and if it's something that is worth underwriting financially, we'll take a look at it. And then there's Josh Welch. Josh Welch is the founder of Three Pillars Capital. He's involved, he comes from a finance and business background. He's been very involved in the investment side and obtaining investor funds for the purchases. George Goyle. George Goyle is a great business guy. He founded his own property management and renovation company called Greenline Management, and he's also a partner at Three Pillars Capital. And so he manages all of their renovations, and he managed the renovations. He is managing the renovations for Camino del Sol. As of this month, we're 46% of the way through the renovations that are there. And our projection was to be at 39, so we're slightly ahead of schedule. And so one of the advantages of having a person on the board or a partner that owns their own construction and renovation group is that they're highly vertically aligned with what we're doing, and we have access to the resources of that company. And if they're involved in it, they of course are there and coordinating and making sure that the job is getting done. So he's our asset manager. Fernando Zampiera is also involved with Greenline Management. He's our project coordinator or project manager. He does a great job with a lot of the details that are that you have to go through. I don't have it open right now, but we've got a 600-point due diligence spreadsheet that we go through and check for each of the apartments. And he does a really good job at making sure that each of those points gets ticked off. And then I'm involved in a lot of the legal talks with the lawyers, the insurance brokers, the other professionals that are there, as well as doing investor relations and being a part of the asset management calls, which are happening on a monthly cadence now that the property's been acquired and is under renovation. So that's the team really quickly. Three Pillars Capital is an asset management group. They're based in Texas. They invest in Class B and C. When we actually found this property, there was around 4 months of back and forth negotiation. So it wasn't necessarily one of the quicker processes. I've seen a lot longer. 4 months is a little longer than it often is. But the seller had not disclosed that there were some CapEx expenditures, some heaters and broken units that needed to be replaced. So we needed to come in with a little more capital expenditures than we were initially thinking, and it caused some back and forth negotiations. Three Pillars Capital targets estimate opportunities that are estimated to have an annual 10% cash on cash return to investors. So that was the projection for this their previous 7 buildings. And a IRR, which is the internal rate of return. Internal rate of return is a metric which is used within apartment buildings, and what it is it's a discounted cash flow value, which simply means that to the investor, every distribution that they get, you calculate the time money value of that distribution and sum them all up in order to get an overall time money value, which is your internal rate of return. And so this is roughly equivalent to an average annual return on the investment. However, it's very precisely calibrated to match each distribution that's being given out. So they have a proven track record of increasing their NOI. Their occupancy levels have been exceeding 90% across stabilized properties, and they have their own Green Line apartment management company that is vertically integrated into their strategy, so they don't outsource it to third parties, and they can save on operational efficiencies. So at this point, we started doing our due diligence, and so nobody has met physically in the real space at this point. We're all talking about this particular property, and we're talking to the broker in particular. And the broker will send us information. Excuse me. So the goal is to understand whether we can reposition this from a C class to a C plus property. Once we decide to start doing the due diligence and the property is together, the team is together, we're going to start on a business thesis. So we look at the property, we start looking at the financials, and do we understand, is this a property that we can improve? Is it not a property that we can improve? Is it being offered at a fair price? What are the large, expenditures that will need to be completed in order to bring this asset to a spot where it is providing a good investor return? So the strategy, the business plan, is to reposition the class from a Class C to a C plus property, which means workforce property, which has been upgraded and has been newly renovated so that it stands out within the current market. Through an extensive renovation program focused on upgrading the property's interiors to push the asset level to a level slightly above that of the comparable properties in the submarket. Our strategy and underwriting assumptions are that the asset is repositioned through upgrades, offering residents higher quality units than competitors at a more attractive price point. With our in-house property management and renewed attractive market dynamics, we will be able to push rent growth on the renovated and unrenovated units over the year. So let me kind of show you what we look at in order to make that investment thesis. And this is all information that we got from the broker. So for instance, and just to show you here, I'm actually linking to a property that is in Memphis, Tennessee for each of these documents here, because the broker sent us documents that were very poorly formatted, and I wanted to show you ones that are nicer formatted. So here's an example of what a T12 will look like. It is, a profit loss statement. Here are the different expenses that take place on a monthly basis. So you have your utilities, your trash, your legal services, your contract services, phone and internet, lawn care, etc., going down to also your management fee. I've seen some really strange things with management fees. We had one person who owned the management company as well as a particular apartment, and he was paying himself a 20% management fee, whereas the industry average is closer to 4 to 5%. And he was doing that because he wanted his company to have a better profit margin, I guess. And so one of his companies was paying another one of his companies, but it meant that the expense statement that we looked at looked really strange because the expenses in this category were way off. Usually you want to get at least the previous 12 months. If you can get more than that, that's better. In this case, they sent us 4 years worth of the expense statement here. The rent roll. So the rent roll is really important for knowing specifically when people started their leases. So you'll look at the leases, and this is very important for your renovation timeline. So, for instance, we were looking at a property in Georgia once called the Vault at Statesboro, and this was a property that was right next to a university in Georgia, and so it was student housing primarily. And one of the things that we noticed was that the end of leases all occurred just as summer began. So and then when we looked at the income statement, sure enough, income is good all the way till June, and then suddenly June, July, and August, the income went to 30% of what the other months were. So just knowing when people are leaving, and so what that means in that case is that, well, during the summer months, we're going to have a very extensive renovation program doing as many units as we can at one time in order to finish them during that time and have them available to be leased up by the time the school year starts. Now that's specific student housing, but knowing when your leases are ending is going to be key for laying out your renovation schedule, and the asset manager is responsible for that. Also knowing what payments and deposits are on hand. If people are used to, putting deposits for pets, or one of the things that's common now also is called a RUBS program, which is a ratio utility buyback system. Basically, a RUBS program, a building that does not have a RUBS program, the price of water and electricity is often bundled with the rent. Whereas if you have a RUBS program, it means that your apartments have individual metering so that you can reduce your rent but charge back the exact amount of electricity, water, and gas that the apartment person is using. So that they're paying their individual share rather than a collected group share. And it's often a good thing because tenants will report leaks faster. They will tend to use less water, less electricity. It's good for the overall building just in terms of keeping prices and expenses down and keeping utility usage down. So the annual income and report statements, they often look like this as well. Oop, that is the wrong link. My apologies. Here we go. So they'll look something like this, generated by a accounting program. You can go through and look and see exactly what the expenses are on a particular place, and then make a calculation as to whether this is something that could be improved or the expenses reduced. The seller's memorandum, I'm going to go through this a little quicker. Seller's memorandum is a document that the broker sends out that is more or less a sales document. Here's an example of one. Yeah, it looks like this. Oftentimes, if you see a really beautiful seller's memorandum, it's a sign that, hey, maybe you're not getting the best price on this property. If you've got an off-market deal, often it won't come with the seller's memorandum. So you'll have to do a little bit of more individual work on understanding the situation of the building, but at the same time, you're negotiating oftentimes directly with the seller. A rental comparison report. So if there are other buildings in the area, what are they renting at in terms of dollar per square foot? And then also the market summary. So once this is done, once you've got the financial audit underway, you perform your underwriting. And here is our underwriting document. It was 122 units at 87% occupancy. We can go through and show all the rental income that's here. This is the quick analysis tab. So we do a quick analysis that basically lets us look at the income and expenses and then decide if this is a property we want to pursue or not. We actually fill out probably 30 to 40 of these for every property that we want to pursue. So it's something that's meant to be very quick. The other thing is that we'll put in assumptions for closing costs over here, including flood insurance, what the acquisition fees are, loan guarantees, the inspection reports, the rehab budget. This rehab budget right here is going to be improved upon once we actually fly to the building. So once underwriting, let me show you a little bit more of the underwriting here. The units, once you have your quick analysis done, you can go into a more detailed level analysis where you actually put in the unit types that you have, what the square footage is, and the total collections for each type is, and then you have your current rent and your current average price per square foot, and then your business plan is to move this column here over to this column here. So you want to be able to raise the net operating income either through improvements to the property that allow you to charge a better rent, or through reductions in the expenses. And then here is where you can perform your sensitivity analysis. So you make assumptions about, actually the assumptions here were this originally, what the average rent increase is going to be. So we're showing a 3% increase in rent, 3% increase in expenses, what the 1 year rehab physical vacancy will be. Economic vacancy. This is a really important number. Economic vacancy is different than physical vacancy in that in a given market, for a given type of unit, say like a 2-bedroom, 3-bathroom, or 3-bedroom, 2-bathroom, there's going to be a certain market price. Let's say it's $800 a month. If you're only charging $700 a month, then you will have $100 of economic vacancy. So meaning your rents are below market by a certain percentage. We can also change the electricity, gas, and water bill-back programs, as well as the property taxes, which actually are increasing at a fairly large rate right now in Texas. Texas is known as having no income tax, but fairly high property tax. Once you get those inputs in, you can make forecasts on a monthly basis. I don't know if you can see this or not, but it's going through and creating the gross potential rent, the physical vacancy, the economic vacancy. So you're coming up with your dollar amount that if everything worked out perfectly, this is what you'd be getting. And then you subtract out your economic vacancy and your physical vacancy assumptions. You add in income from your laundry and from your vending machine, from rental deposits that are being put in, and water and gas and trash reimbursement programs to come up with your effective gross income per month. And then you project that over 5 years or more. Once you have that analysis done, you can summarize it in terms of an annual cash flow here and a return summary. So this is the part that we often include inside the investor package. So when we decide we want to move forward with an investment and we've got a signed purchase and sales agreement, we'll come to the next step, which is to create an investor deck. That's actually what this is, that shows all the details of this particular property. So in this particular case, we were projecting that we were going to get a 19% IRR over 5 years, and that we'd pay 9 to 10% cash-on-cash return, which simply means that if you put $100 in to the property, then you're going to be paid $9 to $10 in terms of an annual rate coming from rental collections. And then the equity multiple here, this is a measurement that says over the entire life period of the property, if you put $1 in, how much can you expect to take out at the disposition or sales? So when the property is sold, what is the projection for how much that $1 will be worth? The investment highlights are that it was directly held in an LLC, that we were able to swiftly lock it up. We locked it up at $58,000 per unit, which was below the, I believe it was $67,000 a unit at market at the time. So we got a great price on it. And it was in a geographically attractive area, with the market rents being 15 to 20% below market, which meant that we had an opportunity to go in there to make some improvements. George was really good at sourcing materials. We got granite countertops at a great price, so we were able to come in and install granite countertops and update the units. Let me actually show you what that looked like. Here's the before and after of the units, and this was actually at a nearby property that was owned by them, that was in the same market, but this is basically the same materials. This is what it looked like before, and this is what it looked like after. Okay, so just to give a quick property overview, it was purchased for $8.9 million. There were 15 buildings included, 122 units. And we had 91,000 rentable square feet, as well as a fairly large amount of land. It was built in 1969, water boilers. The construction is wood and steel joist, and it was 1 and 2 bedrooms. All right. The renovation budget. So let me jump back to my presentation here. I know we're getting towards the end. So once we had a purchase and sales agreement signed, the team flew to the property. So I came over from Portland. A lot of the team lived in Houston, and so they drove over. And then we also had Stefan, who was part of the team, flying from Michigan as well. And so we all converged on the property, and we started to go through the physical due diligence checklist. And that is a property condition report, an environmental assessment, and an appraisal, as well as a green report. The green report's really interesting because there are a lot of subsidies for putting in green technologies. And so you can save energy and put in solar, put in different types of energy saving appliances. And so this is a report on what can be done on the units to upgrade them to energy efficient standards, and then what sort of cost it'll be in order to put those in, and what sort of savings we can see over the long run from different subsidy programs. Okay. And then, of course, once we have a good idea of what the renovation budget is going to be, that's when you negotiate with your loan officer. And our loan officer is Brandy Shotwell. She is awesome. She gives us access to CoStar information on the particular areas that we're looking at. And then negotiating with the loan officer is a little different than negotiating a residential property, because the bank really considers themselves a business partner. And they should. They have a huge stake in the business. So the terms are much more negotiable usually. One of the things that you often negotiate is how many years of interest-only payments can you get. So it's incredibly important, especially during the renovation period, which is often the first 2 years of an acquisition, that cash flow is in demand because it's being used by the renovation crew. But at the same time, you want to keep your investors happy. So making sure that your underwriting can forecast that you have enough cash flow to do that is critical. And one of the things that can make a huge difference there is having interest-only payments for 1 or 2 years. So if you can get an interest-only payment during the time that you're doing the renovation, that frees up cash flow, which can be used either as, CapEx expenditures. So you'll set aside a certain amount per unit, or it can be used once units are renovated and rented out at a higher rate to provide investor return. So having a really strong relationship with a broker is key. Making sure that prepayment penalties, so commercial loans, tend to have very strict prepayment penalties. And this is one of the things that you need to understand going into the property. If you intend to hold it for 5 years, then you don't necessarily want to get a 10-year loan that has a stiff prepayment penalty. Commercial loans are usually anywhere from 5 to 10 years. You usually do not see 30-year fixed loans in the commercial space. And they also come with prepayment penalties or yield maintenance, which simply means that if you are paying it off early, there is a yield maintenance payment that it's basically the bank guaranteeing that they're getting the interest that they thought they would be getting, and that you're not denying them the ability to get that interest by paying the loan off early. All right. Step 4 is then, once we have a investment thesis, we know what our CapEx expenditures are going to be, we know what the renovation expenditures are going to be, and we know what the price is that we are paying for our money over a certain time period. We create a investor commitment process. And so before the property is found, the team needs to establish relations with people that are interested in investing as limited partners. Everybody on the team is responsible for doing that. We have a conversation with them about their goals and be sure to educate them and answer any questions about the process. And the SEC actually requires this. So these investments are not allowed to be generally advertised, meaning I can't take out a Facebook ad or, put the building on a bus bench. They have to be talked about only to people that we have pre-existing relationships with. So the SEC requires that we document the relationship and that we keep track of whether the people that are involved in the relationship are accredited investors or not. Okay, so once we talk to you, have a conversation just about what are your goals, what are our goals, are we a fit for each other, we make that determination, and then once a property is identified, so those people, we're always talking to people, we're always interested in connecting with potential partners. Once we actually find a property, which my personal goal is to find one each quarter this year, but once we do find a property, and it's getting more difficult, the current environment, there's more money chasing properties than there are good properties available that give good returns. So it's important to do your underwriting and to know that you're going to have a good deal before bringing it to an investor. After that property is identified, though, you submit a letter of intent to the seller's broker, and the seller receives the letters of intent, and a letter of intent is just a non-binding bid on the property. So you come to them and say, hey, I'm willing to pay, $8.1 million for this property. And somebody else comes and says, I'm willing to pay 8.2. And one of the interesting things about commercial negotiations is for the seller, it's often much more important to know that the company that is bidding is able to actually raise the money and close the deal. So a lot of times, invest your if I go back up here and where did I put it? Your reputation in the market is key, because you will very, very quickly become known for whether you are able to close on a deal or not. And that seller will often know you by name. So that's one of the reasons why my group, we've joined the Think Multifamily group, which is, you can see more about them here at thinkmultifamily.com. But it's a group of about 100 investors that are, one of the reasons I really like the group is they're a very family-oriented group, and all the people there are personally actually interested in each other rather than competing with each other. So it's a pleasant group to be in, but it's also a very serious group in terms of finding and acquiring multifamily properties. The founder there, Mark Kenny, he's got a great story about how he was, about his family, and if you're interested, I'll let you go find it here. Oh, there they are. So Oh, the reason why we're aligned with them is because as a group, this particular group has around 6,500 doors or units, and we have a really good reputation within the market. So brokers actually know Think Multifamily by name, and Mark Kenny usually particularly by name. So if he's the sponsor on your deal, they'll tend to take you a lot more seriously as to whether you can close or not. And you want to be in a position where you're not offering the highest price, but you're offering the best guarantee that you'll close. That's where you want to be, because that's where you're going to be able to maximize your returns to your investors and to make sure that you're getting a good deal on the property, and negotiating well. So the investor package is created, which is that slide deck that I was showing you earlier. It's sent out to all the people that are interested in potentially being part of the deal. Then the members of the general partnership will contact the partners and just say, hey, did you get the information? Are you interested or are you not? And we start filling up what's called the capital stack. Here's a couple of pictures of the property, by the way, playground and eating area. And this is what these are actual pictures of the property right now. So these are renovated units that are in the property currently. So the capital stack, what we're doing right here is that we're calling people in the limited partnership and securing investor commitments. So this part here is the equity of the capital stack. And the general partnership will often have 20% of the equity, and the limited partners will often take 80%. I'm seeing more 70-30 deals that are out there now. What time is it? Oh, we're getting late. Okay. And then, of course, the bank debt finances about 75% of it. And so in between the time that we get an accepted purchase and sales and the closing date, which is often 30, 45, or 60 days, it's the responsibility of the general partnership to raise funds from the limited partnership and to walk them through and show them the investor deck and ask them if they're interested or not. So once that is done, the money is documents are signed at closing, money is wired at closing, and after closing, the limited partners receive updates from the general partnership about the status of the project, and they collect monthly distributions. So they are not involved in the day-to-day decision-making at all, and they don't have to deal with tenants, toilets, or termites. All right. If you'd like to, here's a quick summary of what Camino del Sol looked like. Here's the lobby area, which I really like the yellow in it, and the outside of the office, the kitchens, the playground. So we have a summary here, the different stats about the project. And once it's closed, the renovation to begin, there's usually a 30-day handing over keys process where you negotiate access, and the previous sellers are also negotiating and on-premise as well. After that 30-day period, you transition over and start renovating the units. So currently, this closed last year. We're currently 46% of the way through our renovations, and we've made a couple of quarterly distributions. And the project is on track for being completed in 24 to 30 months in terms of renovation. And then you have the stabilization period where you prove you have a new level of net operating income to a bank, and then you refinance or sell. And that is how, really quickly, a real estate syndication works. If you are curious about more information about real estate syndications, I do have a podcast which comes out twice a week. Although, and it comes out on Tuesdays and Saturdays. And the idea of this is that we go and talk to different professionals in different metro areas and interview them on their opinions on the current market. So we talk to SEC attorneys and to investors and property managers. And it's a great way for me personally to build a network, but it's also a great way for the people that listen to build a network. So, any questions? And I know I went through a lot. I hope I answered some of the basic questions about what a real estate syndication is and how it comes together. You're always free to email me if you have questions you don't want to ask now, but if you do have questions you want to ask now, feel free. And what time is it? 2 minutes.
There are a couple of them in the comments.
Oh, okay. Yeah, I haven't been able to see the comments. Oh, there are. I may. Let's see. What do you do that? What you can do is that even if you want to make edits on the meetup, okay, that's about the meetup. How did you settle on the specific metric rates when you're looking at the area? So the specific metric rates are often rates that we get by talking to the seller brokers that are in the area. You need to understand that particular area. So we subscribe to Yardi, which is a data service that allows us to pull data about particular metro areas. There's around, I believe, 407 metro areas that are classified in the United States. And we work with our brokers in order to get those. A lot of it is, rule of thumb. So when you're looking at the metrics, it's important to have metrics. But more important than the metrics is the story that you can tell. So say, for instance, in the student housing that we were looking at in Georgia, we ended up bidding on that, and we did not end up getting that particular property. The purchase and sales agreement was signed to somebody else, and it actually turned out to be a really big lesson to us because two of our partners, not me, because I refused to do it, but two of the partners decided to fly out to the property and to tour the property. And we had a letter of intent, but we didn't have a signed sales and purchase. And we thought we were going to get it. We thought we were going to get it. We thought we were going to get it. And the seller kept stalling and stalling. And so two of the members ended up flying out there, touring the property. And they came from Seattle to Georgia and Philadelphia to Georgia. So they went a long ways. And while they were touring the property, the seller signed the purchase and sales with somebody else. So going back to that particular property, the leases were 10-month leases, and in a lot of the area, 12-month leases had become the standard. And there were several other improvements that we can make, but knowing the metrics is important, but knowing how you're going to improve is equally important. All right. I will go through and answer the rest of these offline. Next week, we have, I believe, Stu, who is from the Columbia Agricultural Investment Group. He buys farmland in the Columbia Valley, and he's going to tell us how he goes about doing that and what sort of real estate investment techniques he uses to do that. So I hope you all have a wonderful, safe, corona-free weekend, and we will see you next week.
Thank you.